Hello, ladies and gentlemen, and welcome to our interview with Cindra Maharaj and Kevin Messina. Cindra is a corporate treasury and a risk expert for global consulting firm Baringa, and Kevin is a director at Baringa and a former regulator who worked for the Federal Reserve Bank of New York during the great financial crisis. So, Cindra, Kevin, thank you for joining our Risk Management Show podcast today.
Thanks for having me.
Thanks for having us.
Absolutely. It's my pleasure too. So I believe that we will have a thoughtful conversation on the topic of the challenges of integrating new risks into existing risk infrastructure and old frameworks. So to start off, could you provide us with an overview of the key challenges that organizations face when it comes to integrated new risks? So maybe, Cindra, please go ahead.
Yeah, no, thanks for that, Boris. So
maybe
I think
just
when we
about, sorry, just maybe some background about yourself before jumping into the topic. Sorry.
Yeah, sure. No, so thanks for that, Boris. So quick background on myself. So I actually started, I'm from Trinidad, so I'm from the Caribbean, and I live here in the US. I moved to the US a long time ago. And I started my career in financial services, in corporate treasury, working for one of the large GSIB banks. And I think there I was able to get a true bird's eye view of how do you manage the financial resources of an organization. So working very closely on risk management, working on the balance sheets, working with the lines of business, and was there when we started to work through the financial crisis. And I'm sure Kevin will talk a lot about that, having sat on the regulatory side during that time. And I think one of the things that we found then was sort of how do you start to anticipate some of these risks that are coming up? And some of these institutions were sort of caught blindsided as these came into place. So when we talk about how do you start to integrate new versus old, I think there are a lot of tools and mechanisms and methodologies that are already out there, but it's how do you ensure and how do you develop the right data, how do you develop the right culture within the organization to start to anticipate some of these and then start to embed it within some of the existing frameworks, such as stress testing. And I know, Kevin, you probably have strong views on that, so I'll let you take that forward.
Okay, please, Kevin, go ahead.
Yeah, thanks, Boris. Thanks, Cindra. So just a little bit about my background. So as you mentioned, I did work at the Federal Reserve Bank in New York during the 2008 financial crisis, but I've also spent time between working in industry. So I worked for a number of large banks as well as consulting. So I've kind of seen things from a number of different angles, if you will, from a risk management perspective, which helps provide a lot of perspective that I bring to our clients. But I think and you mentioned stress testing, I think stress testing is a key tool that banks, they've used it for a number of years now, for a long time. But I think that, with the way the world is operating now, there's got to be a better real-time stress testing program that's done at the bank. So, it's no longer okay to just say, we're going to run a stress test once a year, say CCAR, for example, and we're going to be done, and that's going to be it. Now you've really got to be doing it, very regularly, if not daily, weekly, but no more than better than monthly, essentially, because the markets move so quickly now that you've got to be prepared for anything. And I'd also say that from that perspective, the other thing that banks need to take into consideration is, I think a lot of banks for a long time use CCAR as sort of a foundation from which they built their stress tests from. But CCAR, as we know, even going back to the original SCAP, the original CCAR that was done back in 2009, the scenarios that the regulators provide aren't always the most severe, even though they call them, severely adverse scenarios. They're not always the most severe. And so banks really need to be thinking outside the box on what are those really significant events that could occur that could potentially, put them in harm's way. And so when we start thinking about, how to go about doing that, you think about testing around the likes of not just CCAR, but recovery planning, operational resilience for non-financial risk, and trying to think through what events could actually do the most damage to us, and how quickly. could it do damage? So if we've got a system that goes down, you think about cybersecurity, for example, if a system gets taken down, how quickly can we operate before it, it really creates that major issue that could put us into failure mode.
Yeah, absolutely. So with regards to the stress tests, I think half a year ago, a chain of banks in the United States went belly up, Silicon Valley, and what do you guys think went wrong? Of course, we know some technical analysis of stuff like this, but with regards maybe to another risk management practices that very well not well represented in these banks. What would your suggestion?
Please, so I'll
go ahead, please.
Sorry, of course. I was going to lead, and then Cindra can chime in. Yeah. But I think there's a couple of things that came out in light of, in particular, Silicon Valley Bank. With respect to their stress testing. So they were performing stress tests, but they weren't listening to what the stress tests were telling them. And the regulators picked up on that. The regulators weren't pushing them hard enough to fix what needed to be fixed in those situations. And I think that was one of the key areas that Silicon Valley Bank really created their issues, that they weren't listening to it. Because when you start running stress tests, especially if you're running stress tests on very severe events occurring, a lot of times you get banks that say, well, that could never actually happen, so we're not going to worry about it. And that's not the right approach to take. The right approach to take is, what if it does happen? Now what? And I think that's where Silicon Valley Bank really, that's where the shortcoming came about. They weren't listening to what the stress tests were telling them, and the regulators weren't pushing them hard enough to actually pay attention to what the stress tests were telling them.
Okay, Cindra, can you add something to this, or maybe?
Yeah, no, of course, I agree with everything that Kevin just said there. I think when we think about stress testing, it's really done on a portfolio basis or a type of risk basis. So it's sort of, if I think about it, what's the type of risk model? And then you think about what's the type of stress test that I want to run. So there's the credit risk, you have liquidity risk, operational risk, market risk. Then it's the idea of, do I want to run like a single factor sensitivity analysis or scenario? Or there's some other types of mechanisms that you want to look at. Then you think about the type of shock, and then the type of scenario. Is it historical? Is it going to be hypothetical? Is it a Monte Carlo? So there's sort of like a decision tree that you're starting to go down. I think what we've seen with Silicon Valley and Signature Bank and some of the others is essentially that aggregation point. I think that process still stays. And I think that's what we're seeing. It's then when you come down to the results and the aggregation points of it, and how do you start to look at all of those things in combination and really start to look at the interconnectedness that tends to come. So some people would look at interconnectedness, and I know Kevin talked about CCAR as sort of one with the severely adverse scenario, and the scenario may be one way to look at it. But I think there's something around, when you look at the results of stress testing, how do you start to look at that interconnectedness? How are your risk committees starting to come together? What's your governance structure to really say, okay, hold on, interest rate risks, loan losses, what's then the carry-on effect that may happen and the trickle-down effect that may happen? I think that's sort of important. And I think what we're starting to see come up a little bit more and conversations evolving, and Kevin mentioned operational resilience, is more the concept of wargaming. So how do you take some of these very discrete, like stress tests? How do you combine it with this idea of the more strategic ideas of wargaming? And how do you start to say, okay, how do we bring these two things together and use the data that I'm getting from stress tests in some of these very hypothetical wargame scenarios?
Mm-hmm. Interesting. So from your experience, how does the emergence of new technologies such as AI, IoT, blockchain impact the risk landscape? I know we mostly kind of focused on financial metrics such as interest rates move, and other credit risk. And how can companies ensure that this technological advancement are integrated into their risk management strategies? So,
I don't know,
Kevin,
Kevin,
please go.
Yeah,
please
maybe you want to bring up the example at a recent bank where we kind of ran through a scenario exercise.
Yeah, I mean, obviously AI, machine learning, that's all top of mind for banks at this point. And how do you use it to your best advantage, but at the same time, really understanding what it's actually doing for you. So I think about it from a model risk management perspective, where you've got a lot of these machine learning models that are being developed both in-house as well as through via third parties, which is another topic of interest. But when you've got these machine learning models that are trying to generate these, that you're working with from a stress testing perspective, are you fully understanding what they're doing? Sort of, if you actually lift up the hood, do you understand the mechanics of what's actually happening? And I think it's important that the very senior risk folks in the banks really understand that. It's not entirely clear to me that they do understand it at this particular time, because it is very quantitative, very mathematical in nature, and they don't always understand exactly what it's doing. And I think it's important to make sure everybody in the risk function and really within the C-suite in totality really have a good grasp on what these models are doing, and understand sort of what their limitations are. Again, your models and AI and machine learning, they're only as good as the data that gets input into them. And again, I think Cindra mentioned this earlier, right? The data is key, and a lot of these banks, especially banks that have gone through a lot of acquisitions over the past decade or 2 decades, a lot of times their data systems don't talk to each other very, very nicely, if you will. And so, it's the old garbage in, garbage out concept, where if they're pulling data and you're not confident and you don't have the right controls in place that data is accurate, then your model, you could have the greatest model in the world, but it's going to fail at the end of the day.
Cindra, you may add if you have something to add, but I have an additional question for you. For example, as the risk professionals work to update their risk frameworks, how can they strike a balance between accommodating new risks and maintaining the effectiveness of their current existing management practices?
Yeah, no, that's a good question. And I think it kind of ties to the previous one around AI. So I think AI, when I think about AI, when I think about cyber, those are sort of kind of the emerging risks that we're starting to see kind of come up, right, within the industry. And I want to say emerging, they've been around for a long time. I think emerging in the sense of they're getting a lot more spotlight. We're seeing it evolve. And I think it's the way, in terms of how do you start to integrate, it's really through that risk identification process. So you're starting at the scratch. So when we start to think about risk identification, firms have a process in place for it. It's now starting to think through the financial as well as the non-financial risks. And you're starting to see that emerge within the banking industry. In the past, you would always have like an operational risk head, right? But we're starting to see that evolve now, or into some banks are having a financial risk lead, a non-financial risk lead, because the skill sets are different that you need, that are both sitting at the risk committee and coming together. So that's an example of how you start to integrate it. So there's that governance, that cultural piece, but there's also the idea of you have to embed it into your risk identification framework. So when we start to talk about like our CSAs, for example, and sort of taxonomies that are there in place, it's really now starting to say, okay, through these exercises that we're doing, potentially war gaming, potentially bigger picture, what can happen, the geopolitical landscape is changing, all of these things, how do you start to use that and filter it down into your existing, I keep saying it, methodologies, processes there. It's just being able to make sure that you're starting to identify that, and starting to think about it within your overall process.
Mm-hmm. All right. So Kevin, because your company Baringa works with various industry, can you share perhaps some best practices without maybe dropping the names of some success stories where organizations successfully integrated this new risk into their existing infrastructure, leading to improved overall risk management? If there are some things to case studies.
I think, to be perfectly honest, I think it's still a work in progress at most of the banks that I've seen, and it's going to continue to be a work in progress, because it seems like with the regulators, to the extent they start to shift their focus a little bit, in terms of different hotspots, like cybersecurity and third-party risk management tend to be the hotspots right now. Next year, it could very well be something different, and banks will have to sort of pivot toward whatever it is next year. So I do think that, while banks are looking or are working toward that integration and finding that balance that they need, it's still a work in progress at most banks from what I've seen. I don't know if Cindra has any examples of banks that have done it particularly well, but I think that what you get is, depending on the bank, some banks might have pockets of areas that are very good. Other banks have other pockets of areas that are really good. So we know, for example, operational resilience, we know a number of banks are really far ahead in the space and are really, going down the path of, designing scenarios, running scenario analysis, really testing their limitations from a non-financial risk perspective. But we also know that there are other banks that are so far behind, that are just now standing up an operational resilience program, for example. So you start to see sort of different banks at different places depending on where you're looking within that risk.
Mm-hmm. Okay. Cindra, I have a question for you. If we look into the future, and so how do you envision the relationship between this kind of new and existing new challenges and old frameworks, kind of legacy system evolving in the next decade? What skills and strategies will become increasingly important for risk professionals?
I think that's a really good question. I always love looking into a crystal ball, and trying to figure this out. So a couple of things. I think we're going to be guided. At least I can speak from a US standpoint. I think a lot of the guidance that we get from the regulators is going to drive a lot of what this starts to look like, and I think we're already starting to see that. So as a result of SVB, as well as Signature, for example, the FDIC came out recently with new proposals, right, for rules for their resolution plans, as a good example. Well, what is a resolution plan? It's really meant to be the playbook that a bank uses should it be going under, that the regulator is starting to use. And what are they asking for in this new one? Well, they're asking for help us think through some additional strategies in terms of how do you start to think about it. How to help us think through performance testing. We want you to do more capabilities testing of your ability to do things. So what does that mean from a skill set perspective now? I think you're going to start to see, yes, we're going to continue to have very deep subject matter expertise within the risk management framework across the different types of risk. You still need that. But you're going to start to see people kind of emerging, bringing together some of that bird's eye view of how do you start to look across, and can you speak that language across? So how does credit intersect with liquidity? How does that intersect with operational? How does that then tie into, yes, a financial risk element, but also a non-financial risk element? So it's a little hard, I think, Boris, to say this is exactly it, but I think you're going to see a lot more evolve into that, what I'm going to call, yes, that very quantitative, but a little bit more of that qualitative aspect of risk management coming into play.
All right.
I also, of course, if I could add to what Cindra's saying, because I wholeheartedly agree with what she's saying, you're going to need folks who can cut across the different risk stripes. So it's not going to be just a liquidity risk expert. You're going to need a liquidity risk expert, but you're going to need somebody who can talk to liquidity risk and credit risk, basically at the same time, bring it together. But I also think that historically, if you think about the banking industry historically, right, they've always been very hesitant of change historically, and that has shifted now. And you see it now when you open up the newspaper and you're reading about big organizational changes that are going on, such as Citibank, for example, which just announced theirs a couple of weeks ago. You're starting to see that change is almost welcome at banks now. They're looking at it as if we've got to get up to speed. We've got to get with the times, essentially. And so I think that's been a fundamental shift that I've seen within the banks, where it's no longer taboo to say we need to make some sort of organizational change. And like what Cindra was saying earlier, some of that change is going to be having a head of non-financial risk as well as a head of financial risk, and making those organizational changes where you're going to start to see that risk function really cutting across all of the risk stripes.
Just one more piece there, sorry, Boris, to add in. I think one of your questions was around AI earlier on in the segment.
Mm-hmm.
And I think that's going to be another area that we're going to continue to see additional, like, people skill sets moving
Mm-hmm.
down that path. So not just risk, being able to talk across risks, the cross-functional nature of risk, but I think there's also that idea of like technology and how do we start to use AI to help us make more real-time decisions, more risk-based decisions, and can we use AI to just help us create that infrastructure around? And I think you're going to see that emerge as well.
All right, fantastic. So as we almost have our time is up. So if we summarize our interview for someone who is listening and would like to walk away with one or two major takeaways, what would it be? Kevin, please go ahead first.
It's a good question. So I think the one big one in my head right now is the interconnectedness of the risk stripes. So really bringing together all the risks. You can't operate risk in silos anymore. You can't have credit risk sitting here, liquidity risk sitting there, and so on and so forth. They have to be working together as one risk function. And I think that to me is one of the biggest things that especially coming out of what we saw with SVB and Signature Bank, for example, where it seemed like the different risk functions, the different risk stripes weren't talking to each other and didn't realize the interdependencies that they have on one another. Liquidity risk, it may be a liquidity risk issue, but it stemmed from a credit risk issue, and they sort of they feed into each other. So I think that's the one thing that I think if somebody's going to take away, it's going to be understand the interconnectedness and the concentration and the vulnerabilities that banks have across all of the different risk stripes.
All right, fantastic. Cindra, do you have some summary, few points?
Yeah, no, I do. I feel like we've talked a lot, Boris, about risk management and sort of the mitigation factors of it. I think there's an element that we didn't touch on, and what's really important as we talk about that interconnectedness, we talk about operating model, governance structures, is it's not just balancing compliance, but also the value creation aspect that can come as a result of some of these changes. So I talked at the beginning about aggregation and how do you look at that? It's not just mitigation, it's how do you use that to kind of look for opportunities to add value across the organization. So I think there is a element of that's really important. And that's where we're seeing firms like going down. They're like, we're spending a lot of money on managing risk, but where's the value? How do I get value out of it? How do I show value to my consumers? How do I think about that? And that's something, what's my ROE behind some of this? That's really important to consider as well.
All right. So thank you again for joining us today. And I wish you a successful career and your company. Actually, you didn't talk about your company. Maybe next episode we can do something about more what you do, guys. But today is our kind of initial interview. So maybe in a few months you would like to join us again when we discuss more about yourself and what you guys do.
Yeah, that'd be great. And I'm guessing, Pat, it'll be really good, maybe, Boris, for you to just get that blurb on Baringa and sort of what we do to ensure that that's part of the overall picture, because I do think it's important to see that come through as well.
Okay, thanks again.